At the outset, let me thank the organizers for inviting me to deliver this keynote address at this milestone event. And I would like to congratulate TransUnion CIBIL on its 25th anniversary. Credit reporting and TransUnion CIBIL have grown together in India, and the company has made significant contribution in expanding the footprint of credit reporting in the country. Credit reporting systems today operate as a key element in the national financial architecture, encouraging greater credit access, supporting financial inclusion, enabling effective supervision, and enhancing financial stability. This Silver Jubilee, therefore, represents a significant milestone in TransUnion CIBIL's ongoing contribution to strengthening this framework. This also gives us an occasion to reflect on how the information gap between the credit institutions and the borrowers has been addressed over time and possibly the way ahead. To set a context to the theme of this speech, it may be worthwhile to reflect briefly on the evolution of credit information companies in India. Reserve Bank had recognized the need for establishing a credit information bureau for collection of credit information from lending institutions and for provision of such information to the financial system. It had set up a working group in 1999 for the purpose. The Credit Information Bureau India Limited was thereafter incorporated in the year 2000, and over the years, 3 other credit information companies have also started the operations in India. A variety of challenges had hindered the expansion and wider acceptance of credit information companies over the years. The key obstacles included inconsistent quality in the data submitted by the lenders and shortcomings in consumer protection mechanisms. A committee set up in 2013 to examine the issues hampering the sector had made some recommendations, and based on its recommendations, significant policy changes were made in the year 2014. These included standardization of the data formats for individual, corporate, and microfinance borrower segments, institutionalizing the mechanism for technical working group comprising of representatives from the various regulated CICs, and introduction of a data quality index for improving the data quality. In the recent years, our focus has been on taking regulatory measures to improve the quality of data and ensuring faster redressal of customer grievance. Several policy measures have been taken to reduce the information asymmetry, enhance the data quality, and improve customer satisfaction. Just to illustrate, these steps include mandating the availability of a free full credit report to individuals, appointment of internal ombudsman by the credit information companies, extending the Reserve Bank's integrated ombudsman scheme to the credit information companies, introduction of a framework for granting compensation to customers for delayed rectification of their credit information, and increasing the frequency of credit reporting. The Reserve Bank directions have also mandated the CICs to display the list of suit-filed accounts of large and willful defaulters on their websites. The role of data and emerging technology in enabling credit access is therefore extremely topical and relevant at this juncture. But if we were to go back in time 25 years back, lack of information and high cost of access to information hindered access to credit to a large segment of the population and the financially excluded. It was in this scenario that the credit reporting started to take root in this country, and we have traversed a long road since then. Apart from greater access to secured lending, the creditors gained confidence in underwriting unsecured loans, facilitated by the access to credit information provided by the CICs, as this reduces the information gap that existed between even the prime borrowers and the lenders. While the CICs have undoubtedly played an important role in reducing the information asymmetry, thereby facilitating better credit decisions, they are not going to be the only game in town to source the required data, as information asymmetries are also sought to be addressed through other complementary mechanisms. This trend is driven by the digitalization of financial services and the electronification of records, which has created a large repository of data which can be used to get a better handle on the economic trends, both micro and macro. This, coupled with the growth of fintechs and innovations in financial services, has created business opportunities to harness alternate data sets in order to gain a better understanding of financial behavior and creditworthiness of individuals and entities. These insights can give a richer perspective than conventional analysis and provide an impetus to the measures taken to foster greater financial inclusion. Let me highlight a few of these developments, both technology-led and regulator-supported. Let me begin with the CERSAI and the CRILC. In 2011, the Central Registry for Securitization, Asset Reconstruction and Security Interest of India was incorporated, initially for operating a registration system under the provisions of the SARFAESI Act. Over the years, it has developed into a complete registry containing security interest of immovable, movable, intangible properties and assignment of receivables. By providing access to all kinds of creditors and the facility of filing of attachment orders and court orders, the CERSAI delivers a comprehensive status of any encumbered or attached property. The Central Repository of Information on Large Credits was set up in 2013 by the Reserve Bank of India to store and disseminate information on large credits of scheduled commercial banks, all India financial institutions, and certain non-banking financial companies. These initiatives have undoubtedly helped the banks and other financial institutions in improving their credit administration, besides providing vital inputs for supervisory risk assessment on build-up of credit risk in the financial system. At the heart of the fintech revolution in India is India's digital public infrastructure, a framework that integrates technology, markets, and governance to serve public interest. The DPI includes the Unified Payment Interface, which is the flagship instant mobile digital payment system, interoperable across any bank account or app, the Aadhaar Digital ID for over 1 billion adults, the Aadhaar Payment Bridge, which facilitates cash transfers directly to the beneficiaries' accounts, Aadhaar-enabled payment systems, which is an interoperable network of biometric-based cash withdrawal and deposits enabled through agents, the DigiLocker, which is an e-locker for storing verifiable credentials, the Bharat Bill Payment System, now called the Bharat Connect, for bill fetch and pay, and FASTag, a near-field communication based on toll charges, based to largely address toll charges and parking collection platforms. This is supplemented by the account aggregator framework, another cog in the DPI, which is a cross-sectoral framework for consented financial data sharing. Apart from facilitating credit delivery, this is an initiative towards open finance. It has now come a long way and is growing rapidly with onboarding of financial institutions since the guidelines were first issued in 2016. The inclusion of the Goods and Services Tax Network as a financial information provider under the account aggregator framework is expected to give further impetus to the cash flow-based lending to the MSMEs. The latest addition in the digital public infrastructure for credit is the Unified Lending Interface, designed to simplify and democratize credit access by offering lenders regulated, seamless access to verified borrower data. The convergence of the Jan Dhan accounts, Aadhaar and mobile phones, popularly known as the JAM Trinity, the UPI and the ULI, represents a significant advancement in India's digital ecosystem. One of the ULI's standout features is its ability to tap into alternative digital data, enabling access to credit even for those without formal financial histories. Its integration with the NABARD's eKCC portal is expected to extend digital access to customers of district, central cooperative and regional rural banks, previously excluded from formal digital channels. Integration of the state-level digitized data such as the land records and cooperative databases into the ULI framework would provide novel cash flow-based lending solutions. Going forward, the potential for ULI is to also harness data from e-commerce platforms and gig economy apps could open new doors for credit inclusion for the small sellers, the delivery workers, and the freelancers. When we evaluate the outcome of these measures, we can see the significant changes and benefits. I think Bhavesh had just shown the presentation, but just to supplement that, over the years, India's household debt as a percentage of GDP has increased and today stands at around 43%. That's in the year 2024. This rising trend is fueled more by an expansion of the number of borrowers than through just an increase in the average indebtedness. Despite some moderation observed recently, the growth in deployment of bank credit under the retail and personal loan categories witnessed a compounded average growth rate of approximately 17% over the last 5 years. Moreover, the Composite Financial Inclusion Index to measure and evaluate the extent of financial inclusion also has improved substantially from 49.9 in 2019 to 64.2 in 2024, indicating progress in deepening of the financial inclusion in the country. This reflects two important facets of credit that need to be kept in mind. First, availability of credit to individual borrowers has improved, and second, the improvement in the Financial Inclusion Index reflects reduced frictions in credit delivery with consequential improvement in financial access. A targeted beneficiary of increased use of data and technology in credit decisions should be the MSME sector, which remains the backbone of India's economy. With more than 73.4 million enterprises contributing nearly a third to our GDP and 46% to our exports, this sector is key to our economic future. Increasing the availability of credit to MSMEs has been a policy priority of the Reserve Bank and the Government of India. However, MSMEs have faced several challenges in accessing formal credit such as information asymmetry, excessive documentation, and a lack of transparency. Here the role of credit information companies has become important. When commercial credit reporting is efficient, creditors need to rely less on relationships, lending, and soft information, and more on facts and fact-based analysis based on credit reports and other credit reporting products. It needs to be recognized that of late, the fintech players have emerged as a powerful enablers, transforming how credit reaches the previously underserved and unserved populations. By leveraging on the power of technology, they have significantly lowered the cost and complexity of delivering financial services to the last mile. This has not only improved the user experience, but has also addressed persistent challenges that had kept many outside the formal credit fold. Importantly, we are seeing a growing collaboration between the fintechs and the traditional financial institutions. This partnership is particularly impactful in credit origination and supply chain finance, where it bridges the gaps created by physical infrastructure and human resource constraints in the remote and rural areas. For example, in 2024, fintechs have processed approximately 47% of the small ticket personal loans of rupees less than 1 lakh by count. The Open Credit Enablement Network that facilitates interactions between the lenders, borrowers, and loan service providers, effectively unifying all participants within the credit ecosystem on a common platform to streamline credit delivery, is also poised to be a significant part of the financial ecosystem.